Hi everyone, and welcome to Frank Wealth Insights. I'm Frank Fantozzi, President and founder of Return on Life Wealth Partners. Thanks again for tuning in, and just remember, the information on this episode is for general education purposes only and does not constitute personal, financial, tax, or legal advice. Please consult with your own advisors before making any decisions. So today, I am joined by my colleague and teammate and fellow wealth advisor, Danielle LeChard. You might remember hearing her in an earlier episode of our podcast. This is the first time she's appearing with me live on a video. And Danielle, so how are you doing? Welcome today.
Oh, thank you. I'm happy to be here. It's a beautiful day here in Cleveland, Ohio. We're almost hitting 70 degrees. So this is like the first look of spring.
Yeah, outside activities start to begin.
I know.
Well, very excited. So thank you for joining.
Yeah, thank you.
So today's episode, we're going to be diving into what high net worth families should be looking for when they're choosing a wealth advisor. We will cover key criteria, questions to ask, common pitfalls to avoid, so you can feel more confident about finding the right fit for your financial future.
Okay, sounds great.
So how do you want to start?
So I guess, I hear this a lot, how should I be looking at advisors and how should I be choosing? So, I'll ask you some of the questions and
20-question format.
And a 20-question format. So, Frank, so maybe you could start off and just tell us why, choosing the right wealth advisor is so particularly critical for affluent families.
Well, I think picking the right advisor, just like in any relationship, choosing someone or a firm that fits you is important because your ultimate success is going to be how the relationship works. I do feel with affluent clients, people always comment to me, or at least our affluent clients, as they've built wealth, they keep asking, why do we have to be doing all these changes, adjustments, and recommendations? And I share with them that as you develop wealth, the complexity of keeping wealth and protecting wealth is there. So I think their complex needs. They have investment needs, obviously. Mm-hmm. Tax planning becomes a much bigger issue because tax drag is really a negative drag on wealth. Estate planning and philanthropy, those usually are very big, important items for people of wealth. Mm-hmm. Another thing they want to focus on is while you're accumulating wealth, they want their wealth to be protected. So what steps do we take to help with risk mitigation? Mm-hmm. Another interesting part, and it's probably the hardest part of our job, is family dynamics. When you start to have a lot of money, people are cognizant of it, and then there's family dynamics that could create challenges within the family. So how do we work with family governance, for example? Because some of these affluent families are worth more than ongoing corporations. So now you take a management standpoint about how you manage a company, you really overlay that through family governance and how to take care of these families. And then I think just the emotional and psychological support in decision making. I think money becomes kind of relative, but even though you might have wealth, the risk of and the fear of losing wealth and not having it becomes an issue. So I think, how do you establish boundaries and create context for the family so that they feel comfortable in how they pursue and manage wealth towards their goals?
And trust is, a huge point there.
Well, for sure. I mean, any relationship, I think, and your clients the same way, right? Mm-hmm. They probably share more with you in your relationship than they probably do with their family and friends.
Yeah, I hear everything. I'm sure you do too.
Oh, for sure. Yeah, some things I'm wondering, why do we want to hear it? But we're there to hear everything, and
open ears.
Be an open book and try to listen. It's kind of like the bartender mentality, right? Go to the bar and have a drink, and you spill all your stuff to the bartender. So sometimes we're in that kind of mode where we're just listening. And even though it's not our area, we try to be there, because sometimes families need some place to vent and to share, not necessarily that they're looking for just guidance and advice all the time, just having that trusting relationship so that they can share something with you.
Yep, I agree. So if you had to go through choosing an advisor or a team, again, what are some important qualifications or credentials that you would look for within an advisor and an advisory firm?
Okay, that's a fair question, and it's a lot like I'm going to use the analogy to the medical community a lot.
Okay.
Just because you're a doctor doesn't mean you can do knee replacements or spinal surgery. There's specialization, and so there are several, I think, important designations that I think, at least attest to the fact that the individual has certain level of competency, just like you go through the medical boards and you become a doctor, or you become a lawyer, you become a JD. I think some of the common industry designations that you need to be cognizant of are a very common one is a CFP, which is a Certified Financial Planner, which you are.
Yes, I
right?
am.
It's a great designation because those individuals are kind of grounded in various elements of wealth management. Then there's the CFA. It's a Certified Financial Analyst. Those individuals tend to be much more investment oriented. They do a lot of the deep research and tend to be on the investment side of the team. The other is a CPA, which is I always joke CPA, certified pain in the ass, but that's something I've had to deal with my whole life. But a certified public accountant, they're more grounded, obviously, in financial matters. They tend to have estate and tax expertise as part of their strength area. And a newer one, but I think is but still pretty valid, is a CPWA, which is a Certified Private Wealth Advisor. These are all designations that are valid in the sense that that person has the acumen to provide financial advice. I think the key thing for individuals to consider is, are they hiring one advisor, or are they hiring a firm and a team? So the way we work at our firm is as you know, we have a team, and we have various designations throughout our team, and we all bring different angles or lenses to the relationship, so we help and coordinate that way. So I feel looking at firms that have more of a team model allows you to tap the various strengths of all those designations. But doesn't mean that a solo advisor can't help. But I just refer to myself. I think I have a lot of knowledge and experience and expertise, but I'm better as an advisor because I have you on our team, and Chelsea and David and Cynthia. We all round out each other. So I think one of the things affluent families need to look at is, are they really comfortable working with a single advisor, or are they looking at a team that has different specializations that bring that to the relationship? So I think that's really something that you need to consider when hiring an advisor or an advisory team.
Okay, so that's really helpful, and I know that's a lot of letters. I always tell people
Alphabet soup.
It all means something. So can you, and this is kind of going in a different direction a tad, but can we talk about conflicts of interest and what they are and how they should be identified when you're selecting an advisor?
Sure, that's important. I think the industry's evolved a lot, but I think a couple things to look at. One is the compensation structure. Okay. I think when I started back in 1994, people were being paid by what they call assets under management, or an advisory fee, or even a fixed fee. But commissions back then were much more prevalent. So people would assume that, oh, you're just selling me this or recommending this because I earn a commission. So that created a different lens, and sometimes people felt uncomfortable because they weren't sure that the advice you were giving them was objective because, the reason why you're recommending that is you're getting a commission. Mm-hmm. I think the industry shifted a lot. I think today, most of the advisors, not all, commissions still exist, but most of the advisory firms now are based on an advisory fee. So regardless of the investment recommendations being provided, they are compensated based on their fee schedule. So I think it's a couple of things to really look for that are more subtle is fee transparency.
Okay.
So as you know, in our firm, we have a fee schedule.
Yes.
It is the same for all our clients. It's non-negotiable. We don't cut deals with different clients. So I think from an objectivity standpoint, we're much more clear. If there are commissions, if they disclose it, so like in the insurance industry, that's still driven by commission.
Okay.
But as long as the advisory firm is, recommending why you need insurance and why, there's a commission attached, I think they're being very transparent. Another one to look for is what I call proprietary investments. Okay. So a proprietary investment means that as long as you work with this company, that investment can be, looked at and looked out for and recommended. However, if you decide to change down the road, you can't take that investment with you to that new advisor because that advisor doesn't have access to that investment. So proprietary investments tend to be a little bit of a red flag. And so some of the companies out there manufacture their own product. And so you just have to ask, well, is that product transferable if I ever leave? And if it's not, then you have to question, okay, is that really in my best interest?
Okay, very helpful. So, there's so many advisors out there,
Right.
and when I, if I were to be looking for a new advisor,
Mm-hmm.
I would want to know that I was choosing someone ethical, somebody you just said who has my best interest in mind.
And they sit on the same side of the table
Sit
with
on
you.
the same side of the table. Is there a way that potential clients can look up advisors and see if they've had any disciplinary actions or any issues in the past with their professional lives?
Sure. So the good news for consumers is that the industry is highly regulated.
Yes.
It's regulated at the state level. So every state has their own securities exchange kind of group that governs securities laws within the state. There is a self-governing board, which is FINRA, which is the Financial Industry Regulatory Authority.
Okay.
It's a self-governing board. It's not appointed by any government agency. I always equate FINRA to commission. So
Okay.
someone who is a registered advisor, a registered rep, has the ability to earn commission and is governed by FINRA. The other is the Securities Exchange Commission. Those are individuals that are governed as the company itself is a registered investment advisor, and then the individual who you work with is an IAR, which is an individual advisor representative. And so an IAR is someone who works for an RIA firm, and those are the individuals that tend to earn an advisory fee, and they're governed by the SEC. So I think the important difference between FINRA and the SEC is that with FINRA, you only have to meet what they call suitability standards.
Okay.
So that's a lower bar to make. So as long as, based on our notes and the discussions in your need, if the investment or insurance is appropriate for your needs, then I'm okay.
Mm-hmm.
Under the SEC, you're a fiduciary, which means
Yes.
you're personally liable.
Best interest.
Best interest. So if my advice isn't in your best interest, then I could be held legally accountable for that. So it's a much higher standard.
Okay.
So we always recommend, like we do at our firm, is to find a firm that is registered with the SEC and that the individuals that you're working with are what they call IARs under the RIA firm. I know it's a bunch of letters, but that's how our industry is governed. But to your original point, because we're highly regulated, you can find out if there's been issues with any advisor. So these have to be disclosed. For example, if you're an IAR on the SEC Form ADV,
Okay.
if you happen to be a registered rep, FINRA has a thing called a broker check,
Mm-hmm.
and it has to be disclosed on the website of the company. So you can just type in the person's name and find out if there's been any legal action.
Yes.
You can also go to the state regulatory records and look individuals up. So it's pretty easy that if someone had some bad news in their life, it sticks with you. It's not something that expires. So if something bad happened that advisor did in their lifetime, it doesn't go away. So I would advise people that before they go in and I don't call it waste their time in interviewing someone, they should be doing a broker check or checking the SEC
Yes.
guidelines and looking up these individuals to say, all right, have there been any claims against them? Because then you have to make a decision. Why do I want to go in and interview them if they've already had these past discrepancies in their past? So I think that's something you should do before you go in.
Yep. And I do like that it is so highly transparent in our industry. So,
Yes.
Okay, well, I guess on to more of a fun topic,
Yeah.
okay?
Yeah, get out of the bad stuff.
And this is, we have clients who come and interview us all the time, and a lot of times people don't know what to be asking advisors.
Sure.
So what are some specific questions individuals and families should be asking, initial meetings with your potential advisor?
Okay. So I think the first part is really looking at the investment process that, because that's the sexy part of our business. Everyone wants to know about investments. And, if you do an analogy to the car, it's like the engine. It makes the car go. You still need tires and, a sound body and all that kind of stuff. Without the engine, the vehicle's not going to move. And so the common topic we talk about a lot of times when individuals come in is really, what's your investment process? And I think those are questions you need to ask. You need to ask, tell me how you're managing my money. Is it, and I'm going to throw out some terms and I'll explain what they mean, but these are common industry terms. But, do you take a strategic approach in setting up my investment strategy? And a key component, and I forgot to mention this, is that do they develop what they call an IPS, or an investment policy statement, for your family? This is, the analogy I'll give you is like if you have a pet dog and you want them running around the yard, you don't want them going in everyone's yard. So you create a fence, or you do an invisible fence, and it keeps the dog within that space. The investment policy statement does the same thing. It tells the advisor what they're allowed to do and what they're not allowed to do in regards to the investment choices they can advise you on.
Okay.
So at least you have peace of mind that they can't just go off the reservation and buy anything they want, right?
Yes.
So an investment policy statement, I would be asking that. I would ask them, do they take an active or passive management approach? Active means they're proactively looking at making adjustments. Passive is they're going to, just adjust very infrequently and let the investments, ride what they call in a long position.
Okay.
Ask them how often they're making changes. What's the decision-making framework, and how frequent are the portfolios reviewed?
Okay.
Where are they obtaining their research? So are they creating it in-house? Are they buying it from outside, and who are they buying it from? How do they plan for economic shifts and market volatility? How do they handle that? What else? How do they communicate the portfolio decisions? And what I mean by that is, so most registered investment advisors have what they call discretionary control over your account, which means, Danielle, if I was your advisor, as long as I'm staying within the boundaries of the investment policy statement, I can make changes as I feel fits your best interest, right?
Yes.
So I'm doing this on a discretionary basis, which means I don't have to call you every time I go make a decision.
As long as you're in that boundary.
As long as I'm in that boundary, correct. If I go outside, I'd have to amend the agreement and get your permission to do so. So, and that's fine, but how do they communicate those decisions? So I make these changes. Am I just getting a confirmation in the mail that money got changed, or is there some form of explanation provided to me in a letter saying, okay, this is the reasoning we made these changes, Danielle, for your account? So I think understanding how you're going to be informed, how these decisions are made, I think create comfort, because again, this is a trust relationship. So you're asking me to take care of you, so let me take care of you, but I still need to be able to communicate the how and why I'm doing what I'm doing, so you at least feel confident that you have some engagement with the advisor in your account.
And I mean, I've seen that too. I mean, my clients, even if they don't love hearing about the different investment changes, or they don't follow it necessarily, they like to hear why we're doing what we're doing. Just it's an important time for everyone to stay informed. So.
Yeah, especially now with all the changes, the swiftness and the depth of all the changes in the new administration, it's created some turmoil. And so while people are glued and to what's going on in the headlines, or I call the fear lines, you're trying to figure out how to keep people calm and not making emotionally bad decisions. Because ultimately, even though you have discretion, right? If someone comes in and says, "Hey, I want to go to cash," you have to take their order, right?
Yes.
So how do you prevent people from jumping off the ledge? And that a lot of that comes to how you engage with them, how you educate them, how you teach them the process, and why that's in their best interest.
Yes. Okay. Well, can you talk to me about why it's important to understand a firm's risk management techniques when managing money and managing their portfolios?
Okay. Well, risk management comes in a lot of forms. Again, the popular part is the investment portfolio. Mm-hmm. So just like rate of return could be measured, and I think one of the things that's important, and to drop back to the previous question real quick, you should be getting at least periodically performance reports, yes. and they should be set to an appropriate index. So, for example, if I have a bond portfolio, you're not going to compare my portfolio to the S&P 500. It's an apple and an orange.
Yep.
So one of the things you have to agree to with your advisor is what is the comparable benchmark and how am I doing? Right.
Yes.
That way, everyone's on a level playing field. It's fair to the advisor and it's fair to you. The other thing that can be measured though is risk, and so I think that often gets overlooked. So typically, the market's in three phases. It's either in a down market, it's in a sideways market, or it's in an up market. So in a down market, our job, is if the index goes down 20%, the index we're benchmarking off of, and we're down 10, well, no one likes to see a change in value of 10%.
Better than 20.
It's better than 20 because we outperformed in a down market.
Yes.
So in a sideways market, there is opportunity to outperform because there's so much movement up and down. We have the ability to try to outperform through active management. In a bull market, though, the market's just taking off like a rocket. So our job is just to try to capture as much of it. So this is the cycle that markets go through. So part of it is managing risk is that, and this is where numbers can be deceiving. So, they say numbers don't lie, but liars figure. It's an old expression. And, you could take two numbers that are exactly the same as the average return. So I have two portfolios, one's 7%, this one's 7%. But if I look at the account value, which is what, you don't spend your rate of return, you spend what's in your account, right? So the other account could have more money. And people say, well, how can that be when they both did 7%? Well, it's how you earn your returns. And I don't want to turn this into a math lesson, but it's a term called sequence of returns. And depending on how you make your returns, how less volatile the portfolio is, you could actually average the same as someone else and have more money in your account.
Yes.
So one of the things you want to ask the advisors, what are their risk mitigation techniques? Are they harvesting tax losses? Are they using Monte Carlo analysis to help? Are they stress testing the portfolio? Are they using alternative investments? So again, people think, thanks for the reminder, we call it a three-legged portfolio. We look at stocks, bonds, and this category, which is very broad, but it's called alternative investment assets. And I think for today's discussion, I'll say they don't really behave like bonds and stocks. Where traditionally most people invest in stocks and bonds, and that's like a two-legged stool. So if you can look at the picture, you'd say, which one's more stable?
Got it.
So these are things we look at. The other risk mitigation is really looking at your wealth. Do you have your insurance portfolios the way they're supposed to be? Is your insurance and disability protection where it's supposed to be? Do you have unnecessary tax exposure? Because that's a risk. So there are other risks to your wealth that can dampen your wealth, especially in an affluent household, that stem beyond just your investment portfolio. So you want to get an understanding of the capability of the advisor or the firm as to how are they basically treating your wealth and helping protect your wealth, because it's the same thing about earning wealth, but you want to protect it. No one wants to give it back.
Okay. So let's change bases a little bit, and let's talk about service, communication. I know we touched on this a little bit before. Let's talk about advisor capacity. So what level of service should affluent families really be expecting with their financial advisory teams?
Wow, that's a tough question because I think it's very personal and it's very customized. So I think the clear thing first is understanding what your expectations are. How do you like to be communicated, and what information is important for you to feel confident about what's going on? So there's some people that take a executive level approach. I just want certain key information, and if that information looks like it makes sense, I'm good.
Yeah.
Then you have what I call more of an engineer mindset, and one's not right or wrong, but they require much, much more detail.
Quarterly check-ins,
Quarterly
monthly
check-ins,
check-ins, yes.
So I think the key thing is understanding what information you want in a format that's understandable to you, because everyone speaks a different level of, what I call financial IQ, and I think that's where you first have to start. I think secondly is, and these are questions you need to be asking, is in regards to your needs is, tell me, how my reports are going to be customized to my needs. I mean, am I receiving a comprehensive financial plan? Believe it or not, there are advisors out there that I do what I think call financial planning light and then very deep financial planning. And, it requires a lot more effort. It requires a lot more information. And I think understanding how those reports are generated, how regular the meetings are, the more complex you have, our more complex clients, we're having at a minimum monthly conversations or check-ins, let alone more meetings. So I think the complexity, and it's not necessarily net worth. Obviously, worth creates more challenges. But if you're a business owner, you have much more complexity. If you're someone that has just a large W-2, you're probably not having the same level of complexity. So I think the complexity of that client's lives will also dictate the number of things that have to be looked at, the things that have to be checked underneath the hood, as they say. You're going to want to ask, how frequently do we update and revisit our financial plans? I think it's important to come up with some key measures. So I think, again, everyone looks at the investments and the investment statements, but there's so much more. I mean, your net worth statement or balance sheet is like a report card. It tells you how your wealth is progressing. So
Yes.
are you going through the balance sheet? Are you going through your beneficiary designations and your estate planning? Are you covering all the topics like protection planning, estate planning, general financial issues? If you have a business, there's going to probably be business owner questions. So you want to make sure that when you have your normal meeting, that you're going through these touch points. So think of it like when you go to the doctor and you go a physical, right? They just don't say, well, Danielle, how you feeling, right? They take you through the paces and say, has this changed? Has this changed? Has this changed? Even if you're checking it off and say, hey, nothing's changed, but that's what they're supposed to be doing because we live in a fluid world. Your life is fluid. And so there'll be, something that comes up that says, oh, wow, that happened. Well, that's going to have a ripple effect and we need to check this area and this area out.
I always like to tell clients, whenever there's a major life event, birth, death, marriage, divorce, incapacity, anything like that, it's important to update your advisor or, make sure you're on the right track given this new life change.
Yeah.
So.
Well, I know we at our firm, but I know you do this diligently before you even start your meeting. You're always asking, hey, what's going on in your family? Has there been any changes in dynamics and things like that? Change in work, things. These are all things that can have a cascade effect on everything that falls into your financial plan. So at the end of the day, it should be customized, but I think you need to make sure that there's certain areas that you're always consistently talking about, and is the information being provided to you in a format that's one, understandable, but two, actionable. Because just because you meet doesn't mean you say, oh, hey, we met and we go home. There's usually homework. There's some things that have to be taken care of. And so having these action steps, I think, are really helpful in keeping you and your family on track.
Great. Okay, so can we talk about assessing how families would assess an advisor's bandwidth to help them with their specific needs?
Sure. So we talked a little bit about this earlier, right? There's nothing wrong with working, with just a solo advisor. Okay.
Yes.
If they're credentialed right, they have knowledge base, and I'm sure they can handle a lot of things. But I do believe that as the complexity of your life changes, it becomes harder for that advisor to have capacity and expertise in all facets of wealth. Think about it again in a medical form. You go to your general practitioner who's licensed, but now you have an issue, with the pituitary gland, you got to see an endocrinologist. You have a knee issue, you got to see orthopedic. Same thing in a law firm. When you started, your business and it was just you, yourself, and I, then, you could work with a single, attorney. Yes. Now you're up to 150 employees, you have employment law, you have international exposure. All of a sudden you need a larger law firm. So it's usually not that the solo advisor did anything wrong. It's just as a firm, your complexity requires someone that has more financial expertise in these various areas. So I think one of the things that need to be asked for is, what is the capacity and where do they get help when they need it, especially if you're a solo advisor. In a team format in the larger firm, they do have people that are just dedicated to investments all the time, right? They have people that are insurance only. So now these specializations can be brought into the relationship as they pop up in the meeting. So I think those are questions that you need to ask. I think you need to ask about what advice are they going to provide you and what are they not going to provide you? In other words, they'll refer it out. What work do they do in philanthropic advising, administrative support? Another is client to advisor ratio. I remember when we were interviewing for a financial advisor around when we hired you about 4 years ago. They and I'm not picking on banks, but it came from a bank, and she says, "Well, I have 400 client relationships." And I looked at her, I go, 400? How do you manage that? I go, our entire firm, and we have 5 advisors, we have about 300 families between 5 advisors. And yes, there are some that are more complex and some that are not, but you need to look at what I call the client to advisor ratio, because that ensures that you're going to hopefully get enough attention. So that's a question I think you'd really want to ask. And I think that should help figure out if that company or that individual has the ability to take care of your specific needs.
Okay. And I always like to think about, it's a match for, making sure your advisor is right for you, and then also, your advisor feeling like you're the right match. So can you go into a little bit about, a typical, can you describe your typical client to me, and then just give me a couple examples of times you've helped high net worth families reach some important goals?
Sure. So I think that's a very good question. Everything's like on a bell curve. Every firm usually has their very, very large client, I think their sweet spot, and then their smaller clients. And those clients could be clients that they're trying to grow. They're just starting out. Mm-hmm. So I think that's a very good question that you brought up is, what is your typical client's, either net worth or what they call their investable net worth. So those are things that you should be asking, right? I would be asking, what type of services that you specifically provide in regards to your relationship with them. Another one is, what's your succession plan and continuity plan, especially with a small firm or a solo advisor. What happens if the solo advisor gets hit by a bus? What happens to your accounts? What happens to all this information? But even in a team environment like our firm, if someone decides to get out of being a financial advisor or leaves for another firm, the clients need to know, okay, well, what happens to my stuff? Who's going to take care of me? So I think understanding, what the business succession plan is for the organization, mm-hmm. as well as the continuity plan, as well as the continuity plan if there's ever a change with my advisor. Another is, tell me, what lengths do you go through to coordinate with my CPA firm, my attorney, my property and casualty people? Mm-hmm. I know we're very active in reaching out to our clients in regards to, hey, after our meeting, for example, we do our meeting summary with action steps. We ask their permission to provide that to their CPA and their attorney, so they're all looped in.
And that's extremely important in our industry, right? That the CPA is talking to the advisor and talking then to the attorneys.
Oh, so for sure.
Huge.
It is, and we all overlap. Let's face it. We're not attorneys, but when we talk about estate planning, we're doing a little bit of state law. If we're helping someone talk about a Roth conversion, we're doing a little bit of tax planning. But the attorneys and the CPAs are doing the same thing. They overlap with us a little bit. But we all have our specialization. But if you are our client and we want to make sure you're getting coordinated advice, we want to coordinate, because here's what's interesting I've learned. When you come to see when a client comes in, they have their blinders on and say, this is what I want my financial advisor to know. Okay. Then I go talk to my CPA, and this is what my CPA needs to know. And this is my attorney. This is what I'm going to tell my attorney. And guess what? It's important to all three of us. So we really need to make sure everyone's wired in and on the same page. That assures you that you're going to probably get the best advice, not only from each firm, but that the advice is coordinated. And that's probably going to lower your cost. Yeah. Because if I'm doing some work that can make the attorney's job easier and they don't have to redo it, you're not paying extra billable time to the attorney or the CPA. So you want to make sure you ask them, to what lengths do you do coordinate that? I definitely would ask for references. Mm-hmm. I know people aren't going to give you a bad reference, but you could ask some of the same questions that you do to that advisor to the family that they refer you to confirm, okay, is what he or she telling me about how they handle client meetings actually what happens? Mm-hmm. So, you're most likely not going to get a bad reference, but you can kind of confirm the way they manage people, the way they're answering your question because they're telling you what you want to hear. Yes. Are they really doing it? And you'll hear that when you talk to their references. Okay. And again, I think we touched this earlier. What happens if they decide to retire, leave the firm, or become incapacitated? Really, what's the emergency plan? I mean, every business owner has something like that. If something happens to their business, there should be steps in place so that the employees, the clients, the families are all going to be in a good spot.
Okay. So
Does that answer everything?
that answers all my questions
Making
there.
sure.
So, and I know that this is, it probably comes into everybody's mind. So can you give us some ideas of, red flags or pitfalls that people might want to avoid when they are, deciding who's going to really manage all of their money and everything they've worked hard for? So what should we avoid? What are some red flags?
Well, first of all, I think you've really interviewed me hard and well with all these questions. So if you're not getting those questions answered to your satisfactory, I don't think you have to worry about red flags because they've already failed the interview process. I think the other one we talked about earlier was if they have any violations, regulatory violations.
Yep.
Is that who you want to kind of get in business with?
Okay.
So I think those questions and how they answer them and the regulatory ones are the two big ones. But there's some other things that you can look at is in the meeting, do you feel that there's a lack of transparency? Like when you ask a question, they deflect and kind of go someplace
I'll
else.
look at that. I'll look into it.
Yeah.
Yep.
Right. You want, it's okay if they say, listen, I don't have a good answer right now, but let me get back to you. It's totally fair. Mm-hmm. But when they deflect questions and they try to change point because they don't want to answer it, then I feel that there's a lack of transparency. And if they're doing it now in the interview stage where people are auditioning, what do you think they're going to do once your money's there? All right. If you talk about the firm and all that, has there been a high turnover with, key employees and things like that? Are they seem squirrely about talking about fees and how they get compensated? Like I know when we talk at our firm, when people ask about fees, we just pull out our advisory fee schedule and here it is. It's in our ADV. We don't want it to be a source of contention. It's just is what it is. And it's a fair question. If their language talks about excessive guarantees and promises, because obviously in our industry, we can't guarantee future returns. So, when you hear the guarantee word or I promise this, you start to question that.
It sounds too good to be true.
It always is. It always is. Yeah, there's no such thing as a free lunch, right? Do they engage? I get this complaint a lot when we get hired and we always ask, well, why'd you choose us versus another? A common one is, there's usually one in a meeting. There's usually one person that's more dominant, and the person it has nothing to do with sex about the female or male, but someone's usually the money person in the family. But the other spouse is important because they have values and input about how they want goals and needs being met. And what we often get a complaint is that the person that's usually the primary is getting talked to. And then the other spouse, no one engages with the other spouse.
You see that a lot, actually.
Yeah. So that to me is a red flag, because they're not willing to want to listen to what the other spouse has to say.
Okay.
And then the other is, do they talk about themselves or are they asking you questions? So think about it's like dating, right?
Yes.
You go on a date, and if all that person is doing is talking about themselves and they're not asking you about anything, saying, okay, is this someone I really want to go out with a second time? So same thing, you're asking questions. You got to give them room to explain. But a good advisory firm is asking you questions. What's important to you? What is your relationship with money? Tell me some of the good decisions you feel you made about money in the past, some of the ones that you struggled with. Mm-hmm. What's really important to you and your family, and what does success look like? See, these are just good questions to ask because you want the prospective client to be able to establish trust and a relationship to share. And if they don't share, if our clients don't share with us, it's really hard for us to help.
Yeah, we need to understand their goals,
right,
where they're going with their lives. So.
Yeah, I totally agree. So those are things I would say are, besides the questions you've asked me before, these are the questions I would say additional things to be on the lookout for. Okay. That if you don't get that warm and fuzzy, then you probably should be, investing more time elsewhere to find someone else.
Okay. Well, I think, that covered the questions that I wanted to ask you.
Wow, I'm sweating a lot here.
I know. Is there anything else you think we should finish off with?
Well, I want to try to make it easy because we covered a lot, and I know we plan on making the questions available and some of the information that we had today, not only just having the video recording going out, but like a print off of the questions that we can provide if people call in. But I try to really keep it simple. It's when you're talking to an advisor or a team or a firm, do they first have the bandwidth to meet your needs?
Okay.
And you need to understand your needs a little bit. And not that you probably can recognize 100%, because a good advisor will spot like, well, did you ever think about this? But you should have a pretty good command of what you want and need. And I think the second one, and this is, again, really more personal, because you could have, really good firms that really have the same tools, right? Mm-hmm. So there's no difference. It's like driving an Audi and a BMW, two great cars, but yet you got people that love Audi and people that love BMW, and they won't switch. However, you have to look at it and say, I'm having a long-term relationship with someone that I'm going to share pretty much everything I'm going to share. I'm not sharing with anyone else in my family. Yeah. So do you feel that this is someone that sits on the same side of the table, that you have a good feeling like, this person gets me, their firm gets me, I feel comfortable and safe here? Those are really the two, everything we talked about comes down to those two questions.
Got it. Okay. Yeah. Well, thank you for all this wonderful information.
Thank you. Well, thanks for being a great interviewer. You make it easy, I think.
I'll work on it.
Yeah, no. All very good questions and relevant questions, but it's a serious topic, because just like your health, your physical and mental health, your financial health is second. And when people don't have their financial house in order, it creates stresses in a lot of ways. So that wraps up today's conversation. So thank you so much for tuning in. If you're currently working with an advisor and you're wondering if it's still the right fit, or if you've been thinking about making a change and you have questions, please feel free to reach out to our firm. We can provide you a professional guide with all these questions so that you have something in front of you to read when you're interviewing other advisory firms. But if you do have any questions, please give us a call at 440-740-0130, or head over to returnonlifewealth.com, and you can send us a message via our website. And please make sure to like or subscribe Frank Wealth Insights so you're always in the loop. And please reference us to other friends who you think might benefit from our podcast. Until next time, here's to your health, happiness, and living a life well lived. Thank you.